Welcome to episode 23 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I am Will Smith, here with my partners in Minds Capital, Max Lemus and Nicholas James. Today's conversation is with David Acharya of Acharya Capital Partners. David helps run the Independent Sponsor Alliance, something we discuss in the interview. We also discuss David's 20x MOIC on a deal that he exited in December 2023. Nicholas, what did you think of our conversation with David Acharya?
It was a lot of fun. Great to get to know David. And he has been around in the independent sponsor community for 2 decades. One thing that struck me, we always talk about how the independent sponsor model is more flexible. And David brings up yet another point of flexibility that I hadn't actually thought about before. He was part of a partnership with 3 other guys. So there were 4 of them. And around COVID time, they decided to part ways and split up, even though they had 3 or 4 portfolio companies at the time. And if you're in a private equity fund and you want to divorce halfway through, let's say Minds Capital, the 3 of us wanted to split up, it would be hairy. You'd have to value the assets and buy each other out and come up with structures for how to manage, the remaining assets. But as David points out, within their partnership, each of them effectively stewarded 1 deal each, something like that. And so each of them just went to their own. Each of them finished the deal that they were governing. And the proceeds were already defined on the front end. And so there wasn't really a lot of legal complications or operational complications of breaking up. So I would say the barrier to enter a partnership as an independent sponsor can therefore safely be assumed to be lower than for a longer-term commitment like a fund.
That's a great point. Max, what do you think?
One of the things that really stands out to me about David is his ability to articulate that and to understand that value creation in private equity is really derived from much more than just growing revenue and EBITDA. It's about taking an asset, acquiring it at a fair price, and getting it to the next level, not just from a financial standpoint, but from a team standpoint and from a strategic standpoint. It's about taking something such as Impact XM, which was a booth manufacturer, and not just growing EBITDA tremendously, but actually turning it into an experiential marketing agency, adding service lines, building a super comprehensive team and management structure, which allowed them to not only grow organically very effectively, but also to make and to integrate M&A opportunities. In order to really win as a sponsor or someone in private equity, you have to think about who is the buyer at the next level and what do you want to turn this investment into, not just financially, but conceptually. Where do you want it to go? What's exciting? What will make the next buyer feel that this asset is more interesting and more durable than when you first purchased it? And it's obviously EBITDA is it's the paramount scorecard, but there's other scorecards. And David explained that in great detail and had tremendous success with Impact XM, which I thought it was extremely fascinating that they stayed in for a decade. But they got a 20 times MOIC, which is phenomenal. But you have to have a very clear line of sight along the way to keep your investors engaged for 10 years to keep their money in. But if you have that clear line of sight and you're performing and you're integrating, M&A opportunities and growing organically and building this really sophisticated team, I mean, where better for your LPs to keep their money for 10 years?
Well, and it's all the more impressive given that the COVID black swan couldn't have been more targeted at an industry than at conferences. Of course, we all stayed home for a year and a half, and there they were, working directly in the exhibit and conference industry. And so even through that, they were able to transform this business and generate the return that they did. Yeah, it was a great conversation. That point where he talks about transformation of a business, that EBITDA is a proxy for that. Maybe EBITDA growth is a proxy for that. But you got to look under the hood to see the real nature of the business and how it's been transformed or not. He has that line about when he looks at the SIM of the business he bought and then the SIM of the business that they went to market with, the business that they had built, and how just they were completely different businesses, completely transformed businesses. I'll call out the conversation about placement agents. Not the first time that we've talked about placement agents, but David seemed pretty enthusiastic about the use by independent sponsors of placement agents to raise capital for their deals, and he sees it more and more. He says he's a lot of the deals that he's getting in his inbox are brought to him not directly by sponsors, but by agents that have been hired. He talks about the 1% to 2% pricing of placement agents, and how while that might feel steep to a sponsor, a reminder that the capital provider introductions that the placement agent is making are forever. That fee is one time, but these are relationships. If you have a good relationship with a good capital provider, that can be a lifetime relationship that really pays dividends over years and decades. So toward the end of the interview, we really get into placement agents, and he expects this trend only to grow. So I thought that was a good segment. Well, let's get to the interview, but just before we do, a reminder that Minds Capital is actively investing equity in independent sponsor deals. So if you are a sponsor raising for an acquisition, submit your deal to us, deal@mindscapital.co. And if you're interested in investing in Minds Capital as an LP, to be kept in the loop on any future raises, there's a pre-registration form on our website for accredited investors. That's mindscapital.co. Okay, here is episode 23 of the Minds Capital podcast with David Acharya of Acharya Capital Partners. Enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James.
New York-based David Acharya has been in private equity since the dot-com era. He pivoted to the deal-by-deal model during the great financial recession. His first deal, Impact Exam, generated a 20x MOIC after holding it for 9.5 years. David is deeply entrenched in the independent sponsor ecosystem, with strong ties to the SBIA, iGlobal, and ACG. Today, he leads the Independent Sponsor Alliance, a group of 55 independent sponsors who meet quarterly. David, welcome to the Minds Capital podcast.
Well, thank you so much, Nicholas and Will. Pleasure to be here.
Tell us a little bit more about the Independent Sponsor Alliance, this group of peers that you lead.
Yeah, so the independent sponsor community over the last, I would say, 10, 15 years has evolved from, what I like to call the wild, wild west of private equity to now, being accepted as a buyer in the world of, middle market M&A. An independent sponsor is somebody who is a private equity investor without having a committed pool of capital. Typically, the way it works with private equity, the firms go out, they raise capital in advance, then identify deals. What we do is find deals and then raise capital just for that particular investment. And the model has grown substantially over the years to a point that I'm probably the most surprised out of anybody who's been doing this. And I've been doing this for about 15 years. I've worked on multiple investments. I'm probably best known for my last exit, Impact XM. But it has grown substantially over the years, where a number of years ago, one of my closest friends in the business decided to just have an informal group of independent sponsors getting together and just sharing our notes, sharing what we're seeing in the marketplace. this eventually became what's known as the ISI, Independent Sponsor Alliance. We're about 55 professionals. We run our own firms. We have a lot of experience in private equity investing, as well as doing private equity deals under the independent sponsor model. And recently just had a meeting a few days ago. We get together virtually, and we have a guest speaker, typically a capital provider, an independent sponsor-friendly service provider. We can talk about what they can do for our industry. And it was just a great way of coming up to speed to what's going on in the independent sponsor world. It's also a great way of connecting with a lot of experienced people, because once you have a lot of smart people in the room, I think good things happen. And about a couple of years ago, I was asked to chair the Independent Sponsor Alliance, and having a lot of fun doing it.
So how did you start the group, or how did you guys assemble 55 sponsor? And is that a hard cap? How do people join? And just curious to hear about the dynamics and how this got all established in the first place.
Yeah, there was no agenda, with the exception of having a bunch of us at various events, whether it's iGlobal Forum, the SBIA Independent Sponsor Forum, or ACG. And we said, hey, let's just meet by ourselves and kind of exchange notes. And it's very informal. We do have a process of asking you to join. We like you to have some experience, hopefully a platform underneath your belt, somebody who has appeared at various independent sponsor events in support of the community. But there's no secret handshake. It's getting to know a few of us, and then one of us saying, hey, would it be great to invite this person to our quarterly board meetings? And we're always looking for guest speakers, capital providers, equity providers, as well as service providers who target the independent sponsor community.
Well, David, we can cite one very concrete benefit that a sponsor in the group has gotten by being part of it. Neil Doshi, whose episode will have appeared before yours, who's in the group, was burned early in his sponsor career by a capital provider at the last minute. Tune in for that episode, folks, if you want to hear the story. But subsequently, he leans on the group to, among other things, vet capital providers he might use in his deals today, and getting that sort of informal ability to get reviews of capital providers before walking down the aisle with him, he says has been invaluable.
Yeah, Neil's a great guy, and respect his process quite a bit. And a simple question to the group: what has been your experience with this capital provider? And our group has enough experience where I don't ever remember somebody saying, I never dealt with that person before. So we're large enough to really, understand, who are great people to work with and who we may want to think about avoiding. And, one thing, Will and Nick, the world is small, right? I mean, information gets around. So, we're hoping just going forward that, there's enough experience out there where, we can gravitate towards, people that we like to work with and people who've had good experience. And we try to avoid groups that, quite frankly, we didn't have a good experience with. And I think that's a huge benefit for being a member of the ISA.
What would you say are some typical characteristics in the capital providers that you guys recommend to avoid?
If the first question out of your mouth is what's an independent sponsor, that's a clear-cut sign to avoid them. But we're really looking for capital providers who understand how independent sponsors work, understand the role of a partnership, and understand there's a market for economics that are due to an independent sponsor. And you have to be open. You have to be open to working well on all three of those parts. There's some capital groups that want an independent sponsor to be very active post-close. on the board, very active in M&A decisions, very active in financing decisions. And I think that is the model where a lot of my fellow experienced independent sponsors tend to gravitate towards. If you are a capital provider that says, hey, thanks for showing up with the deal, here's a little bit of money, and then we'll see you 5-6 years later from now, it's not necessary for us. A lot of us are deal people. We're investors. We've come from the world of committed funds. We've come from the world of Wall Street, where we understand how the model works, and we understand how a private equity person should behave and act. Investing is a lot different than transacting, right? We're not doing this for the fee. We're doing this for helping investors generate a good return on their investment. And that sometimes requires us, sometimes, always requires us to be very active post-close on the board, on the M&A decisions, the financing decisions, and some of the other, what I like to call the value creation decisions, hiring, firing, getting into new markets, getting into new products and services. So, and improving the processes at these portfolio companies.
What are some other red flags that you sometimes see with capital providers to avoid?
I think the biggest red flag is when you try to change the deal. Okay. And sometimes there's no rhyme or reason for changing the economic relationship with the sponsor. Once a capital provider retrades on a term sheet, it's a little wary for us to move forward and to, quite frankly, recommend them, because the decision to go with the capital provider, a big part of it was because of the economics, and now that decision is now in flux only because you've changed the economics. So, what I would say to capital providers is the term sheet that you agree on and you stick to it will go a long way, not just with the investment, but with the community. Because as I said, Nicholas, we talk to each other. And, when we choose a capital partner, I reach out to the ISA friends and say, hey, what do you think about this individual? And, hopefully, you get a positive response. But sometimes you have somebody say, hey, I had a negative experience because of 1, 2, and 3. And, because I trust and respect these guys quite a bit, their decision plays a very big role in choosing capital partners.
David, just zooming out a little bit and considering the sector of capital providers that are active in independent sponsor land, the aforementioned Neil Doshi story. Neil's impression was that this was a bit of a playbook. He was retraded at the last minute, effectively pushed out of the deal. My wording, not his, but effectively pushed out of the deal. And he had this sense that this might not have been a one-off with that capital provider, but indeed a bit of a playbook. When you look at kind of capital providers as a whole, do you see misbehavior like that commonly? Is this a pitfall that sponsors listening need to be very careful of, or was that an exception to the rule?
I don't know who Neil was dealing with. But, in my experience, most capital providers I dealt with, once we agreed onto the terms, they went along with it, and we've had a very positive outcome. It seems like he may have had a one-off experience, but I will tell you, on the next deal, I'll definitely give Neil a call to make sure that the capital provider I picked wasn't the one that he had a bad experience with. To me, it seems like that group probably didn't have a lot of experience working with independent sponsors, and they took that attitude, which is pretty sad because if it was a very positive experience, they would have had, I would say, a long list of independent sponsors that will come to them for capital, which helps them generate a return for their LPs. So it's a sad experience. We're hoping that it's a one-off. But there will be things like this that you have to be careful for, and the way to protect yourself is making sure that you have multiple capital partners. Because I remember very early in my career, something like this happened, and I just said, "Listen, pencils down. I have somebody else that's willing to do this," and suddenly the issues that they had with me suddenly went away. And that was only because I had the leverage of taking the deal to another capital partner. So I would tell independent sponsors, always try to be in a position where you have multiple capital partners that are interested. Because somebody bails out, your leverage is really having the other person to go to. And if that happens, it's bad for the original capital partner, and it's quite frankly better for you because you're now a lot more closer in closing a deal to a level of economics that you're seeking.
You mentioned that you just had your most recent ISA meeting a few days ago. I'm curious, we're now halfway through 2025. What are you hearing about trends and challenges and opportunities in the independent sponsor world for 2025?
Yeah, I would say, the big is the uncertainty of what's going on in the world, right? You have tariffs, you have geopolitical tensions around the world. Even if you, and then you also have some, internal issues going on in some major cities. So that really, I think, makes a lot of us hesitant and moving forward. Because as an investor, you're trying to anticipate every risk out there. But if you can't measure it, it's hard to make an investment. And I think, the talk is, hey, we're dealing a lot with what's going on in the world. People are moving a little more slowly. I've noticed, when you call a bank and you ask questions, they take 3 or 4 days to call you back. I think some industries have avoided it, like business marketing services, healthcare, I think any type of domestic manufacturing. But some industries, because you have to deal with products and services that come from outside of the United States, makes you think twice about, moving forward about making an investment. So, one obviously is, geopolitical tensions, the tariffs, and I think some internal social issues that are going on in this country. The second is, there's a lot of money out there, and there's a lot of choice, and there's also, I think, a dilution of funds out there that's, looking to put money to work. So you're starting to see some valuations that are, probably not at a point where you can really generate a great return. And I feel that as an independent sponsor, we really can't overpay, because if we overpay, it's hard to attract capital. So I think the challenges of the tensions in trying to find a seller willing to sell to our capital to an independent sponsor is challenging, particularly when you have a lot of money on the sidelines and people can, up their bid just to win a deal. So that's, I think, the other challenge for independent sponsors now is trying to find the opportunity where buyers, the independent sponsor and the seller are seeing eye to eye on valuation. Because I know for a fact that this year I walked away from 3 good deals where I had a good value creation plan, but I just couldn't meet the price. And at the price that they were seeking, I just could not generate the return that, my investors are looking for. So I think, all those factors have played to a much more cautious M&A scene. And once we see some stability in those areas, I have no doubt in my mind that the M&A market will be back across the board.
I want to emphasize what you mentioned there. If an independent sponsor overpays, it's hard to attract capital. This is a really important nuance about the deal-by-deal model versus funds.
Yep,
a fund is going to do 8, 10, 12, 20 deployments. If they're early in their fund, they have the capital, it's easy to imagine that they can rationalize. Let's overpay for this asset. It's, a 100% good fit with who we are. We want to deploy capital. We're going to go stretch on this one, and we'll make it up later in the fund. An independent sponsor, however, can never do that because they raise money on a deal-by-deal basis. So each deal has to stand on its own legs. And if you overpay, if you're above market, it just simply is not going to be possible to generate the security for lenders and or returns for equity investors that is required to put the deal together. For me, this is one of the most attractive components of this space as an investor.
Yeah, if Nico, there's a lot of research on exit, entry and exit multiples done by the private equity industry, but there's also research that's been growing on the independent sponsor scene. And if you look, the average multiple that an independent sponsor gets into a deal, it's typically a low single digit. And that makes sense to me because, think about, I bring a deal that I overpay for it, let's say a double-digit multiple, and I go around to my network of family offices. They have or independent sponsor-friendly funds. They have the choice of getting in and getting out, all right, into a deal. They're not forced to put that money to work with me. And if it's not an attractive multiple, you're just not going to raise the money. And let's say you do find some people that will give you the money. Nicholas, it's harder to make even more money because your entry point is so high. In order to generate the 20 plus IRR returns, you have to make sure that everything goes right during the whole of the investment. And hopefully you can grow that EBITDA and you can, get some multiple expansion on that to make some money. But there's a lot of ifs in that and a lot of things that can go wrong. And, one thing I've learned about life, not just in private equity, but life in general, don't expect everything to go right. There's a lot of things that you have to deal with. And I think, that's the discipline that independent sponsors have when they bring deals to capital providers, which is, if I bring a deal that is expensive, that's a double-digit multiple, the chances of a capital provider going along with me is very, very small. But if I bring something that's attractively priced, as well as having a very credible value creation plan, and maybe post their close acquisition plan, the rate of success of raising money suddenly goes up.
I could not fail to disagree with you less. David, you talked about the trends in 2025, and it sounds like you said valuations are up. Deal flow is a little bit more constrained because of all the global uncertainty, but there is still ample capital trying to get into this space.
I would say, valuations, they haven't declined. Okay, they're still stubbornly where they are, and I wouldn't say they're up, but it is a challenge to even if for a funded sponsor to find a valuation that works for both the buyer and the seller.
David, why don't we pivot now to hearing about your Impact XM deal?
Sure.
Would love to get the headline numbers of that, but a little bit of a spoiler. You had a tremendous 20x MOIC on that, held it for almost 10 years. So I generally see incredible performance and shorter hold times. Usually longer hold time indicates maybe not the best performing investment. This seems to be an exception to that rule, so we're excited to hear about it. If you'd start with the headline numbers of the whole deal and experience.
Yeah, so I entered into Impact around 2014. In fact, it started at a previous firm, and which was also an independent sponsor, and we completed 8 acquisitions. We did organic investing where we hired quality people across all levels. We opened up new offices. We offered new products and services, and we have to also deal with COVID. When COVID hit, it changed the portfolio company trajectory for a little while. They were in the face-to-face business of trade shows and consumer events, and when you can't meet in person, it puts a little bit of a damper in your business model. But
and what did XM do? What did Impact do?
Yeah, so they were an experiential marketing agency. Basically, they manufacture trade show booths, consumer event platforms, any type of experience where they're trying to get a buyer comfortable, or where they're trying to reach out and create experiences amongst brands in various industries. So if you've gone to a trade show, if you've gone to a consumer event, if you've gone to an internal convention or meeting, Impact would work with their clients in setting all that up. So we did creative, we did strategy, we did manufacturing and installation and dismantle. It was really, I would say, a one-stop shop for large companies to reach out to their audience.
And tracks tightly with the conference and convention industry, presumably.
Yep.
Okay.
If you've gone to a big trade show in Vegas or Orlando, it's a good possibility you've probably visited an Impact XM trade show booth.
And what was the size of business on entry and then on exit? Give us a picture of that.
So without getting into a lot of details, it was a low single-digit EBITDA number. We grew it to about 13 times over the life of the investment. I would say, most independent sponsor deals, you're typically, the entry level is a low single-digit EBITDA. And we had a great capital partner that we dealt with. We had about 7 or 8 family offices that also invested alongside with us. And, we worked very closely with management in developing the thesis. And once we agreed on how we were going to go about it, we told the management team, execute, and we'll support you in turn. We supported. Typically, the independent sponsor supports portfolio companies primarily on the M&A and the financing side. We're not there day to day at the company level. We expect the management team to do that. And then, we had the only time management saw us was really 3 board meetings a year on the premises. And then, we had a monthly phone call to kind of review the, year-to-date numbers and what's happening in the industry. And we always ended that call by saying, what can we do, to grow this company? And so I was very active on the acquisition front. We looked at nearly 200 acquisitions during our hold period. And, some of the add-ons, didn't make sense. Some of them we couldn't get there on valuation. And some of them, we just didn't see a compatible culture with Impact XM. And but we saw 8 of them, and pleased to report that all 8 of them really worked out for the company and made Impact XM a very attractive acquisition candidate when we brought them to the marketplace in 2014.
And the attractiveness of the business was based on what would you say? Was it just you had grown 12 or 13x EBITDA? So was that incredible return based simply on the fact that you built a much bigger business over 10 years? Or was there some strategic value to it as well that your acquirer perceived or wanted?
Well, I think it's a little bit of both. I think, the next acquirer doesn't really care how much of a return you generate. They care about the returns that they're going to generate. So they need to see a platform where I think having an experienced management team to do acquisitions, to professionalize the operations, it was probably key for them. And Impact XM had a lot of experience in doing both. So it was very easy, I think, for the next buyer to find this to be a very attractive, platform. You'd be surprised. Lower end of the middle market, a lot of C-level executives don't have a lot of M&A experience, but this team developed that M&A experience during our hold period, and I think they also recognize the fact how much value private equity can bring to the table. And whenever there's a problem, we're incentivized to solve that as quickly as possible because that generates our returns and hence our compensation. So I think the next buyer looked at Impact and said, wow, these are a lot of great inputs, a great management team, experienced. They really recovered nicely from COVID, which was hard because in this business, a lot of the competitors didn't quite frankly recover. And then they have a lot of acquisition experience, and they had a lot of experience in growing the company organically. So if you take all those fronts, it didn't surprise me that, we found buyers to find this to be a very, attractive platform for the next stage of growth.
David, I referred to the longish hold period of 10 years earlier. I assume a big part of that was the fact that COVID hit and you
Correct.
had to survive and then wait it out. So that would have been, what is that, 3.5 years earlier. So you may have sought an exit in 2020, 2021 and had a more conventional hold, but you had to basically tack on 2 or 3 years to survive and then thrive through COVID, I guess.
Yeah.
Right. This was in the bullseye of COVID, this industry.
Correct. I mean, when COVID hit, I knew this company was going to do well because it had a great management team, had a great CEO, and whatever the industry threw at them, they handled it really well. So I just saw this as another bump in the road, and I felt that if the company recovered nicely, we could generate a great return for our investors. And that bet ended up being, the right thing for our investors. So could we have sold in 2020 at a very low rate? Yeah, I'm sure we could have found somebody, but I knew that there was a good recovery story here from COVID. And what is very interesting is when we sold the company, I remember taking the original SIM out that I used to evaluate the initial platform company and realized it was 2 separate companies. It was, we're proud of the fact that we're able to take, this small company and really create a national, experiential marketing solutions provider. And I still keep in touch with the team. They looked at a couple of overseas acquisitions that they recently completed. So I wouldn't be surprised that, they went from being a great national experiential solutions provider to now being an international experiential solutions provider. But you're right, the 9.5-year-old was a lot longer. But I think that's another advantage of the independent sponsor model that, we're not forced to put money to work, and we can be a little more judicious about when we exit. We don't have the fund commitment lifeline. We're not forced to put, a company for sale because, we're trying to, we're in the 8th year of a 10-year fund. So I thought that gave us a lot of flexibility, and I think the investors were pretty happy about the final returns.
You initially acquired this platform when you were at AGI, where
Correct.
You were one of 4 partners at an independent sponsor shop. And then at some point during the 9.5 years, you transitioned it so that it became more of your solo platform, if I understand it correctly. Could you explain what happened there in the journey?
Oh, sure. I joined AGI 2013, and the plan was to, grow as an independent sponsor, as a team. And then, if all goes well, we'd raise a committed pool of capital. And, so I had a lot of fun working there. I still keep in touch with all my former colleagues. In fact, 2 of the partners I actually spoke to this week. But around 2018, 2019, we all kind of looked at each other, and one, partner wanted to run a firm, run a company. Another partner wanted to do more early stage investing. And look at me, guys. I look like a New York private equity guy. I'm not doing anything different. We all wished each other well. We still see each other at the same conferences. A few of them I've attended personal events outside of the office with my former partners. I know when you hear about this, you hear about a lot of yelling and screaming, a lot of lawsuits. It was none of that. We wished each other well. We just wanted to do something very different. And
You
at
mean
that
when you
time,
hear?
yeah, at
You
that
mean
time,
when you hear about breakups? You hear a lot about. Okay, yes.
yeah, I hate to use the word breakup because it wasn't a breakup. We all looked at each other and said, hey, listen, guys, I'm a private equity guy. I'm going to continue to do this. One of my partners wanted to go run a firm, run a company. Another partner, moved back to his hometown. And then the fourth partner decided to focus more on real estate. So, I spoke to all four of them recently and very friendly. And, I continue to see a lot of opportunity in lower end middle market. So I started my firm in January 2020, but I was still managing Impact XM and its sister company On Location as portfolio companies. And little did I know that 3 months after I started my firm, the whole world would shut down. And, I had a pretty big lesson about timing, but also about having to deal with whatever the industry throws at you. And it was a big, big learning experience. And I was glad that, the company not just survived, but flourished. But our investors did very well in this. And it has opened a lot of doors for me. We continue, my team and I continue to look at new platform investments. To the left of my screen, there are 3 SIMs on my desk. So after I'm done with this meeting, I'm going to be going through those SIMs and finishing up my morning cup of coffee.
But going back to the amicable divorce, it sounds like emotionally it was okay, but how did you solve for it legally since you had holdings together?
Well, 2 of the 3 holdings we sold, and the third holding, had to manage till the exit. And, our relationship was already documented. So, there was really not a lot of work there. There was not a lot of decisions that we had to make as a group going forward because, we had it all finalized in the agreement going in. So, there was no decisions that we had to make going forward. And so
this was Impact Exam, you mean?
Yeah, exactly. So
okay, so you had 3 portfolio companies headed into the divorce, or when the divorce was kind of first circulated as an opportunity. You divested 2 of them, so that's pretty clean and easy. The kids have moved out of the house. The third kid is now in high school. All is kind of prim and proper. And you said that the paperwork, what specifically do you mean? Do you mean that the paperwork was already organized in a way where each of you had X percent and how it was managed was already a board, a management team? So whether or not you were together in the hold co, still looking and searching for new deals is completely independent of the portco itself. Is that what you mean?
Yeah, correct. All our economics was set, all our responsibilities were set. I was on the board of, on Impact XM and On Location, and it just made sense just for me to continue to manage it until we exited. And, I had a responsibility to my partners. I had a responsibility to the family offices that invested in the deal. I had a responsibility to the fund that also backed the deal. So I wasn't going to leave anybody high and dry. And I worked, at it to make sure that I returned more money than what they gave me 9.5 years earlier.
But so hypothetically, let's say there was a 2-way partnership here. You guys were 4, but let's just for simplicity say there were 2 partners. You had 2 portfolio companies. Each of you had kind of governed one each. Your partner's deal in this scenario divested, so that was clean. And then the deal that you were governing, you just continued to run that until exit. So you didn't actually transition it into Acharya Capital Partners. It continued to be an AGI holding for the full 9.5 years. And when you exited, each of the partners got their proceeds. You get a pat on the back for having stewarded it as the chairman or board member. And so legally, that there was nothing here to do at the time.
Yeah, correct. And, I think any partnership, you contemplate a bunch of scenarios and you make sure that it is reflected in the agreement. And that's what happened. Because I think a lot of independent sponsors, they will go through this. You'll find one partner that, may just say, hey, listen, I want to do something else. And another partner that says, okay, we have this investment. Where I think things go bad, Nicholas and Will, is when you don't accommodate for this. Then suddenly, it's a much more difficult extraction. But in our case, we contemplated that a lot of these things could potentially happen. And if it happens, are we okay with it? So I actually knew how this was going to play out, when I got involved with my partners, way back in 2013, 2014. So, listen, I wish we all continue to work together. I really liked working with those guys, but sometimes life is different. And
Right.
yeah, and when I started Acharya Capital Partners, I still had an obligation, and I'm proud to say that I fulfilled those obligations and ultimately generate a great return for our investors.
So yet again, we hear the word flexibility come to the rescue for independent sponsors, this time in the form of being a good way to split up, since each asset stands on its own and is governed with a predetermined set of board members and so forth. So it's easier to enter a partnership, it's easier to exit a partnership, and then we discuss elaboratively in other episodes how flexibility is a key feature of the independent sponsor model in general. So going back to Impact Exam, you bought it for single-digit EBITDA, so by that I at least hear 2, 3, 4 million, something like that. You grew EBITDA by 13x. So now you're talking about 30, 40, 50 million EBITDA company. Clearly entered multiple new zones as far as EBITDA zones go, as we like to say. Let's do a little bit of an attribution analysis to where this growth came from. Yeah. First, how much of that 13x came from M&A and add-on acquisitions?
I would say about half of it did. And, Nicholas and Will, the way I look at acquisitions, growth has to come from organic investing, i.e. running a business, and growth has to also come from acquisitions. And I think if you can lever both, you have a good company that you can sell. If your growth comes from acquisitions, it does not become a very attractive candidate going forward. And if your growth is all organically, there's no sense of doing acquisitions. But if you do both of them, you should get some really, really good growth in EBITDA. I would say a big part of our returns came from EBITDA growth, and then because of size, there was multiple expansion. So between the two, we were able to sell the company for a very, very attractive price for our investors. And it's our playbook. It was my playbook from the very beginning. I do not get involved in an investment unless you see growth from both organic investing as well as complementary acquisitions. If you're seeing from one or the other, it's probably not a good investment to pursue. You'd have to see returns from both.
I agree. I think when you say that you had a 20x MOIC, some portion of that would be attributed to a multiple expansion. And that's fair. And that's what you aim for when you buy these targets. But when you talk about 13x growth in EBITDA, none of that has to do with multiple expansion because you're just talking about a straight number. And so you're saying about half of it comes from inorganic growth. You're saying it's an important growth lever, but you're also saying it can't be the only way. I agree. But to give you a pat on the back there as well, there's always a risk that the acquired EBITDA declines or goes down. So when you say you actually did see successfully a lot of growth from M&A and that it was sticky and you were able to integrate it, it's an important part of the story because your buyer will know that, oh, they are successful at integrating companies. They have a management team who has a playbook around this. And so for your buyer, that becomes something they can rely on going into the future as well. The other half of your growth story is organic. And so how much of that would you say came from price increases or new services or just doubling down on the core?
Wow, that's I would say all of the above. It's hard to break that down, but we had a talented group of of business development and or account directors. And a talented account director will continue to flourish if they have more products and services to sell. So we as a board said, okay, what do you need to grow? Okay. And suddenly, people's hands raised up and said, it would be great if we had this service, or it would be great if we could offer this rental, or we can be great if we could do, digital programming. And so when we looked at our acquisitions, we looked at the revenue mix. We were, I would say, very intelligent about how we did our acquisitions. And it wasn't about, hey, we can buy this at a low single digit, add it on, and then hopefully sell it for a high, or sell it for a higher, multiple. Yeah, that's part of the story. But are we really making fundamental changes to the business? And the answer is yes, because, I look at the first SIM that we, looked at when we acquired the platform company, and I looked at the SIM when we sold the company, and it was radically different. We went from being a simple boot manufacturer to now suddenly, investing in creative and strategy, offering multiple products and services. So not only we were able to do the boot manufacturing, we were able to offer audio, video rentals. If they didn't want to do trade show booths and they wanted to do conventions and meetings, we had a group that did that because we acquired one of our add-ons was specialized in that area of experiential marketing. And then, we looked at certain industry verticals that we wanted exposure to, and healthcare was one of them. It's a very attractive vertical. And one of our add-ons was very healthcare focused. So, as you add a lot of these positive attributes, it changed to transform the company. And I know transform is like one of those overused words in private equity, but it did. And I was able to prove that by just taking the exit SIM and the entry SIM and say, these are two different companies. And the fact that we were able to give these products and services to these account directors and revenue and EBITDA went up showed that our thesis worked. And we had a great team that executed on that. And that's what made it an attractive candidate for the next buyer.
Well said. I think growing EBITDA is one thing, and that's a numerical thing. But as you point out here, building out a more versatile, robust business with a stronger and broader management team is all part of the package when you want to have a multiple expansion. It's not just simply the number growing, it's also the organization, I should say, transforming and becoming stronger.
Yeah, because, if you reached out to my former vice presidents and my former associates and ask them, what's my favorite question to ask during the Monday morning meeting? And I'd always say, okay, I would always say to them, just from a business standpoint, what is this thing going to grow to? And is it going to be an attractive candidate? If you're just taking a bunch of small companies and putting them together, and there are no synergies between the companies, I don't think it's an attractive candidate for the next buyer. We have to do something that is different that will make it a very attractive candidate. And, if you look at my, thesis presentation, when we got into Impact, we took what was basically a booth manufacturer and created an experiential marketing agency by investing in the areas that we thought was good. And we did. And we did a lot of work before we went into the investment as to what areas that we wanted to expand in and what areas and industries we wanted to avoid. And by doing that, we were able to grow a really, really good company.
David, as we start wrapping here, just two more quick questions for you. We talked a little bit about placement agents on our pre-call. You said that this month alone, you've had 3 calls from placement agents raising for sponsors on for particular deals. Say more about what you're seeing in the market there, please.
Yeah. So, what's funny is when I started this post the 2009 credit crisis, nobody knew what an independent sponsor was. In fact, we used this dated term called a fundless sponsor. And then, I fast forward to now, 2 of the 3 calls were with global investment banks. okay, that raises billions of dollars in the IPO market and the debt capital markets. And, they sit down with me and they said, hey, we know that how your model works. We think it's very attractive. We have investors that like to participate on a deal-by-deal basis. And they said to me, we can do the fundraising for you. And if you know anything about fundraising, it is a full-time job. And, even when you're going out and having dinner with some friends and you identify somebody as a potential, investor, you go in marketing mode. So I think the street has recognized that the independent sponsor model will grow. They're starting to see a lot of people who have worked at committed funds go the independent sponsor route. And raising money is a full-time job. So I think they realize that there is a niche in the marketplace that they could fill. And they reached out, and I got to say, the presentations were very professional. Some of them had quite a bit of experience raising money with the independent sponsor community. And the investor base is an investor base where if the independent sponsor decides to raise a fund, you already have a group that you can call on. So it's growing, and it's growing. It seems to me that there's always a fund placement agent reaching out to an independent sponsor these days.
And David, is there, for the sponsors listening, is there any downside or pitfall that they might consider when considering using a placement agent rather than raising themselves? How should sponsors who've never used a placement agent think about it?
One, look at the record. Okay. And if they've done work with independent sponsors, ask for references. Because anytime you have somebody that you hire to raise money for you, in the back of your mind, there's always that, are they working for them or are they working for me? Okay. Because guess what? They're not going to close the deal unless the investor comes into the investment, right? And so sometimes there's that agency risk that you have to think about every time you hire a bank to raise money for you. So I would tell to anybody who's thinking about hiring a placement agent, ask for references, ask for the track record, ask who they've done it for, and then reach out to that independent sponsor and say, hey, what do you think? If it's a very good experience, they'll say they brought me investors who I never thought I would ever see before. They did a good job in placing and positioning my investment, and I got really good fund economics. Well, that's a great investment, right? That's a great relationship to pursue. But then, there's some sponsors who will take you to investors that you already know, right? And I don't think that's a big value add. So I always, I had another independent sponsor ask me for a reference on a fund placement agent. And, I said, I had a very positive experience. The deal didn't close because there was a diligence issue, but they introduced me to investors who I didn't know. And if for some reason down the line I was going to raise a fund, they already expressed an interest in taking a look at the fund structure with me.
Yeah.
So
it's certainly a way for a sponsor to justify the fees of a placement agent, that the fees will, of course, be taken out of this deal. And so they might feel expensive from that perspective. But if you take a longer term view and you amortize those fees over the relationships that are being built for your subsequent deals, that fee burden starts to feel a lot less. And speaking of the fees, though, just so we can hang some numbers on this, what are the typical fees that you're seeing from placement agents?
I would say on average, anywhere between 1% to 2%. Okay. The funds placed. And, if you accommodate as you pointed out, if you accommodate the fees and the IRR, it does not swing the analysis that much. So if you can find the capital and focus on what you do best, which is grow a company, it's I would say, a worthwhile endeavor.
And the sponsor working with a good placement agent with a good track record, what will the sponsor's role then be in the raise?
I don't think it's not a diminished role. your name is on the front cover when is on the term sheet when they go raise the money, and investors are going to say, "Can you set up a call?" And I think the advantage of the fund placements is two ways. One is the investors, they have a book of investors that they can call that you don't necessarily know that they're looking for independent sponsor deals. The second is they can do a lot of the administrative work that, quite frankly, will take a lot of your time. Okay. The 3 to 4 emails that go back and forth between a family office and you and trying to set up a Zoom call can all be handled by the placement agent, right? If there's a good scarcity value in a deal, the placement agent can push back on negotiating terms that are detrimental to you and put terms that are better for you. So it doesn't diminish your role. I think it just makes you focus on the things that you'd like to focus on and the value add of the fundraise role. And I think a good placement agent does a lot of the other things to kind of diminish the activities you don't necessarily want to focus on, or you just don't have time to focus on.
Yeah. So the placement agent, one way to think about it is they'll handle the blocking and tackling of just, setting up calls and all the back and forth that goes into that, the other administrativa that goes into that, introductions to capital that
Correct.
You presumably don't have access to, might not even know about. And yet you as sponsor, of course, then will still be having pitch meetings and you'll still be interfacing directly with these capital providers. But the overall workload of the raise has, you're just kind of coming in at those strategic moments where you're actually directly interacting over a call with a capital provider.
Correct.
Everything else has sort of been, you've empowered the placement agent to lead.
Correct. Yep. And I think this makes it a much more efficient process.
How big does a deal need to be to interest a placement agent? Or how do placement agents think about working with you, sponsor? Is it size of deal? Presumably it's also your own track record as a sponsor. A good placement agent probably won't just take all comers.
Correct. I think it's a combination of your track record and the size of the deal. I think there are a lot of placement agents that I think get excited at $25 million and higher, but also there's a pathway to raise more money, further down, particularly if you're doing a buy and build strategy. But track record was key. I know that I spend a lot of time with placement agents just kind of reviewing what I've done, how I've done it. They've done their reference checks. And I think that's key because, when they go out to the marketplace with your name on their pitch book, they're putting their reputation on the line. So they have to, make sure that, they look for quality sponsors to back and look for people who can become quality sponsors. So between that and minimum raise, I think those are the two most important qualities to go with when you go with the placement agent.
Great. Thank you, David. Last question for you. You had used the phrase law of small numbers
yes,
to characterize the independent sponsor ecosystem these days. What did you mean?
So, I live in New York City, guys. So every little thing costs a lot more than what we do if you live in a small town. And, a lot of people say, well, if you can buy a single digit EBITDA company and do a bunch of add-ons, you can make a lot of money. And I'm like, yeah, that's absolutely right. But the risk is also a lot more higher, right? And then, if you look at a platform that started with 10 million and higher, your job becomes a lot more easier, I think, because you have a much more sophisticated management team. Chances are they can handle acquisitions. So, and they can also handle some of the more sophisticated corporate financing techniques that we have. So I also say, like, sometimes when I look at a really small company, let's say a $3 to $4 million EBITDA company, I like to use the term, the law of small numbers may kill these guys because you're going to be doing a lot of work and may not necessarily get a good return on it. Now, yes, I have a portfolio company that did very well, that started off as a single digit EBITDA company. We did 8 acquisitions. But, the challenge, I think, on the lower end of the middle market is trying to find a management team that can kind of handle that. When you're a $3 million-ish, $4 million EBITDA company, you have a management team that may not necessarily understand how to do acquisitions, doesn't necessarily understand how to do integration. So, I like to say the hard part is, can we professionalize these operations, and can we handle growth? If not, it's probably not a good investment to pursue. So I always like to say it's the curse of the law of the small numbers here, where it says sometimes you look at a bigger company and you're like, okay, you're not going to get it at a great bargain, but you're buying a pretty good asset at a reasonable multiple. You can still make money off of that. And you remember, at $3 million of EBITDA, you have one bad quarter. That's a big swing in your EBITDA number. Versus, with a $10 million EBITDA company, you have one bad customer. You can recover from it, a lot more easier, because you have other customers. Hopefully, with hopefully the customer, you don't have customer concentration. But it's a lot easier to deal with problems when it's a much more bigger company. But that's not to say that, buying a small company and doing a bunch of add-ons, that's still a great way to make money, but the risk is obviously a lot more higher. Easier said than done.
Sure. Of course, you'll pay less of a multiple to account for some of that risk. But in your orientation is that the sweet spot of risk-adjusted return would be a bigger company.
Correct.
Great, David. The firm is Acharya Capital Partners.
Correct.
And
Yep.
we'll provide a link to that. We'll provide a link to your LinkedIn in the show notes so that people can reach out. I assume you'll get some people eager to be part of the group, invited into the group. We were certainly intrigued by it. Anything else you wanted to share with the audience before we let you go?
Guys, I truly enjoyed talking to both of you and sharing my experiences. Thank you so much for what both of you have done for the independent sponsor community. I've been following you guys on LinkedIn, and I thought you guys not just had some quality speakers, but really some thought-provoking thoughts about our industry. So thank you both for what you've done for the independent sponsor community.
I appreciate that, David. Thank you very much. Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraisers. See you in the next episode.